Right. What's up, guys? Hope you're doing well. James here from Forsythe.com. And so, is the dollar starting to end? Right. There's been a lot of talk the past few years about hyperinflation, things like that. But basically, everyone's going to lose confidence in it, even though it's the reserve currency of the world. And so, I just kind of want to go into a few more charts about it, specifically with foreign holdings of U.S. dollars, not just FX reserves, but also dollar-denominated assets and various ones like even corporate bonds and equities, things like that, right? And then kind of comparing that to other countries. And sorry, one second. Sometimes I forget to turn that off because I'm so used to having a fan, but sometimes if it's turned up all the way like usual, it has feedback. But anyways, um, so specifically with like equities and corporate bonds, things like that. So with that being said, we're going to head straight over to a screen share of the blog post that actually has the charts. And again, um, this is from the New York Fed in their blog where they post economic data and stuff like that. It's actually a surprisingly decent source, right? So they normally I'll scroll down to it to show you guys. They normally have like sources, related readings, how to cite it, and they also have like there's somewhere in here where they actually cite in the like hyperlink um, academic articles in there, which are very helpful. But it's kind of a good place to initially get into a topic and then kind of branch out from there. Um, Especially if you want that kind of point of view that you would expect from a Fed. So obviously, or the Fed. So obviously, it shouldn't be surprising that they don't think the U.S. dollar is coming to an end and that they're going to maintain its importance internationally, right? Which shouldn't be surprising coming from the Federal Reserve, right? And so going into this, crisis containment efforts included basically, I didn't intro this very well on this one. So for talking about transferring or maintaining the dollar hegemony from like GFC only, and then also the March 2020 with the pandemic and all that. Like, and also now kind of with the background with like Russian sanctions and things like that. Like, how is that going to play? And we'll get a little bit more into that specifically later. Um, Basically, how do we maintain dollar hegemony in the world, right? Throughout global crises, right? So crisis containment efforts, as they put, which they're including is enhancing the Federal Reserve's lender of last resort role around dollar funding. And this would be, as an example, central bank swap lines, and then also shoring up bank resiliency under the Dodd-Frank Act, they put in there as well. So this type of reinforcement of dollar roles has been strengthened since 2020 with dollar funding strains and stress periods reduced by access to the Fed swap lines. In addition, the new FIMA, Foreign and International Monetary Authority repo accounts, give those official institutions holding U.S. Treasuries the possibility to get dollar liquidity through liquefying rather than liquidating these Treasury assets, right? So basically, other central banks have the option for central bank swap lines, where they can basically, from my understanding, do a currency swap for they can get U.S. dollars for funding, right? Um, and then from there, you have this FIMA entity, the Foreign and International Monetary Authority, having repo accounts, right? Basically, something they created so that now these foreign entities um, have a kind of designated facility to participate in repo. And one of the things that this piece actually kind of helped me understand was I never heard of liquefying the assets or whatever, and so I wasn't sure like if there's a technical definition at first to where like how when you liquidate an asset, you're just selling it off. But I was like, well, that's not really what's happening with repos, right? So basically, what they're talking about is through repos, repurchase agreements, they're essentially having, or they're essentially transferring or conforming their treasuries into dollar liquidity, like actual dollars themselves. In this case, it would be, I guess, they would be central bank liabilities. I don't know if it'd technically be bank reserves because not sure where FEMA, if it's like an entity of the Fed, like the standing repo facility, or if they just have that part. So I have to look at it. I'm not sure if FEMA is a separate entity or if it's like one of those other facilities that's kind of under the branch of the Fed, like the standing repo facility, or if it's related to that at all. But essentially, basically, having these foreign countries can now have their treasury holdings converted into dollars through repo much more easily, and they have a designated facility for that, right? And this is one of the things they're talking about as enhancing the Fed's ability as a lender of last resort, right? And so, reduced emphasis on unilateralism and protectionism in recent years has also worked in favor of the U.S. dollar's international roles. And we'll see how this plays out further because that might be changing, or at least it seems to be changing, right? Specifically with what's going on with the world, because this was written in the beginning of July of this year. So, this was just over a month ago, right? And so some things have been happening since then. Um, like China's doing missile tests over Taiwan and things like that because of Nancy Pelosi going there or whatever. Um, I don't follow mainstream news. So basically, all my stuff is from newsletters and investment things that I pay attention to. So if there's some other kind of part of that, I don't think it's very arguable that it's not like kind of a propaganda machine at this point, which doesn't necessarily mean it's negative, it's or wrong. It's just that is what it is, sort of thing. Um, anyways, so of course it is possible that the desire to avoid this type of sanctions, we're talking about Russian sanctions at the moment, environment could lead to de-dollarization for some other countries. And so this is where you're kind of seeing, with the Russian sanctions and the freezing of FX reserves and things and other Russian assets that are they're basically their claims, they're Russia's claims on assets kind of denominated in US dollars, or even if they're just dollars in general. Um, not even just dollars, but other Western countries doing it as well. Um, those sanctions kind of showing the rest of the world it's like, hey, how reliable is this? And like, how reliable is this current system? And if something happens, can we basically diversify our risks to maybe having a different system that we don't need the US dollars for, which is kind of that whole de-dollarization argument to where this is kind of a catalyst for other countries to run away from dollars, right? Because the US would basically be using the dollar as a weapon to force other countries to do what they want, right? But that just kind of seems like geopolitics. Um, so to continue, in which case such incremental movements would lead to larger cumulative reductions and fragmentation in the dollar's international roles, kind of chipping away at the whole hegemony and everything. And this might be seen as kind of like a bifurcation of the planet again, or I guess the globe, um, with the different countries and stuff. You having a much more defined difference between East and West, um, meaning like you have the West with the Eurozone, the Americas, and probably Australia, and those kind of developed countries in there as well. And then you have the East, where you have more like the Middle East, Asia, China, Russia, kind of those being the major players and things like that, to where there's like instead of having everyone in New York City for finance kind of in the world, it's more diversified to where maybe you see like Dubai becoming a major financial hub or something. Just giving an example, right, to develop a concept or point, right? And so over the past several years, another key trend has been the prevalence and growth in the use of digital currencies, such as a CBDC, a central bank digital currency, right? So a development that raises questions about whether such alternatives could eventually supplant a significant portion of the US dollar's international role in cross-border payments and investment and trade sanctions. If you guys haven't seen my playlist yet on CBDCs, I've been going through various academic papers and also ones that were I did a series of papers that was a collaboration of multiple central banks like BOE, Bank of England, Bank of Canada, uh, Board of Governors of the Federal Reserve, I think the Bank of Australia or whatever they call it down there. Um, and then also the BIS was in there. I know they're not a central bank, but basically they did a series of papers of their research in the concept of central bank digital currencies and kind of the cost benefits. And it was more of like a discussion series. But I have a playlist of 20 something videos, at least as of this stream, um, on that specifically going into different things. So I will put that as like an end card or something at the end of the video so you guys can see it, um, if it's helpful, right? Or you want to look more into those specifically. But basically, would with the world going through this kind of digitalization of finance, right, in terms of, I guess, Web3 or whatever you want to call it. And we're going to be specifically talking about currencies at this point. And so, like, with that kind of development happening, how is that basically, specifically like the Federal Reserve in the United States, they're worried about, from a finance perspective, the use of basically, if they don't develop a CBDC, they're going to lose dollar hegemony, right? And so that's kind of a major argument for such a currency. So, um, and this is also talking about not only just CBDCs, but also cryptocurrencies in general and how they're basically like they'll try to maintain a peg to the dollar to kind of like a emerging market currency as an example that needs to peg to the dollar to basically fix itself, right? Or to stabilize itself in general, right? And so basically, like right here, some CBDCs may strengthen the international role of the dollar. Basically, the dollar needs a CBDC, as they argue, to maintain its international role. So some evidence and charts. Um, so again, the dollar is a reserve currency, and then basically it's used as reserves, and dollar-denominated assets are also used as reserves in certain respects, right? And so here is kind of two charts of what's one chart with an expanded part off to the right of basically FX reserves, or so you can see you have the USD share, which is the blue line, and then you have it basically FX adjusted in the red. You can see it has been declining from around 2000-ish. Um, it was in the lower 70s as a percent, and now it's down below 60%, at least as of this chart. And this goes into, looks like, the beginning of 2022. And the FX adjusted is based off of the 1999 exchange rates, right? And so, yes, it's the dollar's share of global reserves has fallen by just over 10% in the past 20 something years, but it's still 60 something percent or just below 60%, right, of the world in terms of global reserves, right? And so that's not an insignificant amount, right? So yes, it's been declining, but it's one of those, could it be the end or what? Right? Is it just going to keep going or what's going to happen? But you can tell, I mean, a couple decades in a pretty significant trend to where it seems obvious is kind of probably going to happen at some point, right? I mean, all fiat currencies fail. It's just kind of a question of when, right? And how long. And these things don't happen overnight, right? So, in private transactions, although the US only makes up a quarter of global GDP and just over 16% of world exports and imports, the US dollar continues to be represented at a disproportionately higher rate in financial transactions. Approximately half of all cross border loans, international debt securities, and trade invoices are denominated in US dollars, while roughly 40% of SWIFT messages and 60% of global foreign exchange reserves are in dollars. So this is the 60% in global foreign exchanges we just talked about in the chart above, and just giving other statistics on why the dollar is probably not going to lose reserve currency status anytime soon, right? There's a lot that goes into it, and it's not necessarily just the currency, it's kind of the whole network that comes along with the currency. So it's not just what the US does, it's what the Eurozone does with the US dollar, it's what Africa does, it's everything. I mean, there's an entire Euro dollar system holding all of this. Don't need you. I don't know if that window popped up for you guys. I had a pop up for something. But anyways, so basically what they're saying is like relative to the US dollar's global share in GDP globally, um, it's significantly higher than its proportional amount, right? And so they say the same thing with FX transactions. They're heavily dollar based with close to 90% of all currency trades having the dollar as one leg of the transaction. I did show a chart in one of the other dollar videos I did. So I'll try to find exactly which one that is and link it so you guys can find it if you need. But there's an actual chart showing um, the percentages for all these FX transactions, right? And where the dollar is relative to that. And so the US dollar remains by far the most traded currency according to the latest BIS triennial survey in 2019. And then with respect to global sovereign debt, the US has the largest investable market, thus providing a deep pool of liquidity for dollar denominated assets, right? So foreign ownership of US government debt is currently around 25%, which is a notable decline from 37% in 2013, and as increased US Treasury issuance outpaced foreign investor demand, right? And so basically, on aggregate total, foreigners are holding less US debt um, relative to the entire amount. Obviously, it's a percentage, but is that necessarily due to just us issuing so much since 2013 or actual lessening of demand, right? And when you exclude the Fed's holding, this goes from 42% down to 32%, right? So there's that as well. Here's two charts. So you have foreigners holding U.S. private and public assets. And so this left one is basically government debt held by foreigners for six major countries: France, Germany, Italy, UK, US, and Japan. So you can see that Germany is the highest, and this in terms like the German boons, as an example. What percentage of those are held by people who are foreigners with respect to Germany, right? And so all of these lines are with respect to said country, right? So you can see the U.S. is this kind of grayish, and it's right here to where it was around like 25% ish in 2006, and then it kind of went up to around it looks like 35 in 2013 or so, and now it's back down to 25%. Um, but I wouldn't say that's a major trend. It's just kind of back to where it was 17 or so years ago, right? And you can see how this is with respect to other countries. And so on the right, you have other U.S. assets, so not government debt. And this is broken up into equities, corporate bonds, treasuries, and agency and MBSs, right? And this is aggregate total. This is not a percentage. This is in trillions. And so you can see with equities, they're pretty much all increasing, right, relative to 2019. So this chart doesn't even go back as far. It's only like 3.5 years, right? And so from 2019, it increased all the way into, let's say, mid to late 2021, and that's with respect to all four asset classes. And then basically, it slowly started to come down from there. But is this due to the actual, I guess, valuations of said assets, or is they're actually selling them, right? Because this is in trillions, so I'd assume, like with the decline in asset prices in the past few months, this has a significant degree on this. But it's also like I don't know if the relative movement here kind of proportionally reflects the decline in asset prices. So that would make me assume that kind of that differential between where they were and where they are now is being filled by more foreign demand, is what it seems. Because since the prices themselves are going down at say, we'll just make an easy example, if the prices went down 20%, right, then we would see a 20% decrease in this chart if foreigners weren't buying anymore. But since we don't see that same proportion um, of a decline, that means that foreigners are still buying more, right? Is where I'm kind of going with that, right? And then more concluding to marks and things like that. And so basically, some official use indicators do point to some erosion, notably in FX currency reserves, which we talked about before. And then the use of economic sanctions has caused some countries to rethink their reliance on the US dollar, which isn't a surprise. I mean, pretty much anyone who has a brain and was paying attention to the sanctions and all that could assume that was going to happen anyway. And so basically, finally, I guess I should say, moreover, how many transitions can I put in the same sentence as I'm thinking? But rising U.S. public debt levels and inflation could become more concerning to foreign investors. And I thought this was interesting in terms of inflation because a lot of the podcasts that I listen to, they talk to like foreign hedge fund managers and things like that to where it's like, and they're like, they don't care about inflation in the United States really, because especially like foreign investors, it doesn't seem like they don't care about consumer price inflation, really. Um, I mean, again, I guess unless you're trying to price in a recession or something of that idea, and you're buying like U.S. companies and things like that. But it's always a relative game, right? So if you're a foreign investor, you're looking at that investment from your perspective, and this is all relative to your currency, right? If all your expenses are denominated in euros, right? Then if the United States has a CPI of 9%, you don't care. What you care about is how the dollar is doing relative to the euro because that's what's applicable to you, right? Obviously, this is changing if, like, say you're running a business or investment fund or whatever, to where you're denominated in dollars and and your customers are denominated or and your customers or whoever you're servicing has their debts and expenses denominated in dollars, and then it matters, right? So it's really depending on where your expenses are, it seems. Otherwise, it just seems more like a relative play depending on where you're from and what you're having to pay versus what you're making it, right? I hope that makes sense, right? And so basically, they finish off with say no currency replicates the US dollar um, in these respects as a currency, pretty much. But that's it. Basically, using the swap lines in the FIMA repo to basically reinforce the US dollar's role, right? So, with that said, I'm going to leave this here. As always, I'm going to cite the source so you guys can find it if you want. Look at the charts, use them for whatever you need. And yeah, I'll put the CBDC playlist in there so you guys can find it, and I'll try to find the other dollar related videos to basically backing that up, right? Because there's quite a few other charts in there that weren't in this post specifically. That would be helpful. But anyways, I'm gonna leave that there. So I hope you guys have a good night, and I'll see you on the next one.